Every major market crash started with the exact same warning signs, and some people are saying they're starting to flash again right now. I'm talking about 1929, 2000, 2008, 2020, 2022, and beyond. And every time we see a market downturn, three things happen. Number one, most people lose money. Number two, some people stay the same. And number three, a few people get rich. And ironically, market downturns are actually some of the easiest times to build wealth if you're prepared, because good assets go on sale. In this video, I'm going to show you the science of a financial crisis by studying history. That way you can be prepared, and that way next time it happens, you can be person number three. How much is this market worth? $1, $3, $10, $100,000? The price of this marker ultimately depends on what somebody else is willing to pay. And for me to figure out the real market value of this marker, I'm going to have to go onto the street and find somebody to buy this marker, which is a lot of work. But in the stock market, it works a little bit easier, because on the stock market, people are buying and selling. Let's assume this is a stock. This stock, every second, thousands of times, again and again and again. So the fair market price of this marker is fluctuating based off of what somebody else is willing to pay for this marker every fraction of a second. So if this marker is trading for $5 a share, but you think it's worth $10 a share, well, you're going to come in and buy this marker as long as it's cheaper than what you think it's worth. But if you own this marker at $5 a share, but you really think it's worth $3 a share, you're going to want to sell this marker as fast as you can, so long as you can sell it for more than what you think this marker is worth. Now, hopefully that all made sense, but it gets even more interesting when this happens. Let's assume this marker is trading for $5 a share, but you think that this marker is worth $1,000 a share. Now I know what you're thinking. Who in the world would pay $1,000 for a marker? Well, history doesn't exactly repeat itself, but it does rhyme. In the 1600s, when tulips were first brought to the Netherlands, yes, I mean the tulip flower, people started buying tulips because they were beautiful, and because people kept buying these beautiful flowers, the prices of these tulips started to go up, which, by the way, tulips are my favorite flower. So the price of tulips started to go up, and that's when the financial people said, these farmers and people are making money off of these tulips. Why can't we, the financial people, make some money off of these tulips? So the financial people got involved. They said, we want to buy tulips too. We don't want to actually take care of the tulips and plant the tulips and control the tulip bulbs. How about we just buy a contract that says we have ownership of tulips? We created a derivative of the actual tulip flower. Then that's exactly what happened. The financial people started creating these contracts and futures contracts of tulips, saying that they have ownership of tulips. And as more of these financial people started buying tulips, well, now we have more demand than supply, because we have more buyers than sellers. But they're not actually buying the tulips per se, they're buying a contract that says they have ownership of these tulips. But now, because they have so many buyers of these tulips, that's bidding up the price of these tulips, well, now these tulips are becoming a whole lot more valuable. And that's when these financial people started telling their friends, hey, you might want to get in on these tulip trends, because these tulips are getting very valuable. They're getting very expensive. And it got to the point where people started to sell their houses or pull cash out of their houses through a refinance. That way they could take all that money and buy one tulip bulb, because people were getting so rich because of these tulips. And that was when the merchants, the farmers, said, oh my God, we're sitting on these tulip bulbs that are worth a fortune each. We should liquidate some of these tulips. We should make some of this money. So that was when the farmers and the merchants held an auction to sell off some of these tulip bulbs. That way they could make some of their money, because people were selling their houses to buy one tulip bulb, and nobody came to buy the tulips. Turns out people didn't actually want the asset, which in this case with the tulip, they just wanted to get rich. And when it became clear that people were buying these contracts for things that were essentially worthless, some of it was a flower, it had some value, but not as much as a house, the price of tulips came crashing down. This was known as tulipomania. This was the first known financial bubble in history, and when the bubble burst, a lot of people went bankrupt because they put their entire life savings and sometimes debt to buy one tulip bulb, and when they realized it didn't have that value, well, they lost it all. Now, why am I telling you a bedtime story about my favorite flower? Because the science of what happened, or the tulip bubble craze, happens again and again and again, and the people that understand this can become incredibly wealthy, while most people get hurt. So while they're a beautiful flower, they're also a beautiful financial lesson. I'll show you what I mean. In the 1990s, the internet started to become very popular, and that was when the financial people realized that this internet stuff is becoming extremely valuable. A lot of money is being made. We want to own a piece of this dot-com industry, so we saw money flowing into the dot-com industry faster than we had ever seen. If you started a company and you put the words .com at the end of it, you could go to a venture capitalist, raise a couple $1 million without a business plan, without a penny in revenue, and now companies were going public on the stock market without revenue and raising millions of dollars because everybody wanted to get rich. Yes, there is merit in the internet, but now people were just throwing their money into these dot-com companies because, well, they just kept going up. Well, in the year 2000, that bubble burst. Why? Because interest rates started to go up by the Federal Reserve Bank, which made money and lending more tight. And that was when investors started to be a little bit more cautious as to where they were investing their money. And that's when it became apparent. We are valuing these companies with no revenue, with no real business plan, at huge $1 million, if not hundreds of millions of dollars worth of valuation. Something might be wrong. And as people didn't keep paying those high valuations, prices came crashing down. We saw the NASDAQ, which owned these tech companies, fall by around 78%. Even Amazon stock fall by more than 90% during the dot-com bubble bursting. Some people lost everything. A few people became rich. In the early 2000s, there was this big movement that every single person in America needed to be a homeowner because that's how you become wealthy. And then it got to the point where financial people said, home prices keep going up. So if we incentivize people and make it essentially so everybody could buy a house, now we, the bankers, can get richer, and everybody gets to own a house because now you don't have to pay rent, and the value of this asset, your home, goes up. So now we started creating these ninja loans, which is no income, no job, no asset loans. You didn't really have to have any proof of income or any proof of assets. In fact, you didn't even need a down payment because it was 110% loan to value mortgages, meaning if you wanted to buy a $200,000 house, they would give you $220,000 of mortgage. That way you had money to buy a new TV and furniture for the house as well. Not to mention the fact that now we added in subprime mortgages and very low requirements, so pretty much everybody could buy a house, and this then created a big bubble. Home prices started to go up like crazy because everybody kept buying houses. In fact, they started buying houses for their neighbors, their dogs, their cats, and everybody because why wouldn't you want to own as many houses as possible that keep going up in value? You don't have to put any money down, and you're going to get rich. Well, that was when interest rates started to go up. And a lot of people had what was called variable interest rates, meaning you would keep the same mortgage rate for a few years and then it would adjust. And as interest rates started to adjust at the higher rates, people started to have higher payments. So you went from paying $1,000 a month to $1,800 a month or $2,400 a month. And people started to realize that, oh no, I can't keep making these higher payments. Let me sell my house. And as more people started selling their houses, there weren't enough buyers. And so sellers then had to start cutting the prices of the houses. But still nobody was buying because they were so expensive. And now these sellers were underwater. They owned a house with no equity. They couldn't sell it. They couldn't afford the monthly mortgage payments. So instead of paying the next mortgage check, they just mailed in the keys. And this then created foreclosures and bankruptcies, created a whole recession, but it also led to the housing market collapse of 2008, which also led to a stock market crash. Again, most people got hurt financially, but some people became incredibly wealthy. Now, the 2020 pandemic crash was a little bit different because it wasn't actually the economy that led to the crash. It was the shutdown of the economy that led to the crash. So the economy got shut down and naturally markets crashed because, well, nothing was moving and no money was being transacted. So we saw the fastest stock market crash in the history of time. And again, many people lost money because they were scared, while some people became incredibly wealthy because they were able to buy great investments at a discounted price. We saw the same thing happen in 2022 when we saw the stock market fall by 20-some%. And again, some people panicked. They lost a lot of money while a few people became incredibly wealthy. The reason why I'm pointing this out isn't to say, oh my God, look at how crazy history is. It's because history doesn't exactly repeat itself, but it does rhyme. We have seen 16 recessions over the last 100 years. We have seen 25 market crashes over the last 100 years, which means we have averaged about 1.6 recessions per decade. We have averaged more than 2 market crashes per decade. It is going to happen again. And we're going to see the same patterns happen again and again and again. And I want you to understand this. That way you can use these downturns as opportunities as opposed to being the person that's losing so much money. So let me lay out the same things that we see happen again and again and again. And I'm going to show you how you can actually end up on the winning side when these downturns happen. The 5 things that we have seen happen in every single economic downturn that you want to pay attention to are: number 1, there's an asset in demand. What does that mean? In the 1600s, people wanted tulips because there was a beautiful new flower that everybody wanted to get their hands on. In the 1990s, there was an internet company because this was a new concept, the internet, that people wanted to be a part of this new movement, and people were creating very new innovative businesses. In the 2000s, it was housing. People wanted to own a house. And then leading up to the 2020 pandemic and the 2022 market downturn, it was just stocks. People wanted to own a piece of these rising assets. And then number 2 happened, that demand started outpacing supply. And what that means is that people started to realize that this asset was growing. And because this asset was growing, people wanted to start buying more of the asset, but started pushing this asset price up. So we have this cool asset. Now the asset price starts to go up because people are starting to catch on that this is very interesting. And that's when the financial people get involved. The financial people said, people are getting rich because of these assets right here. So let us get involved and put some more money in and maybe start creating some derivatives, some new way of investing money. So we started seeing all these derivatives of housing market related products in the early 2000s because of the stock market and the housing market. We started seeing huge sums of money going into these dot-com funds because everybody wanted to get involved, because dot-com companies have tried to see the same thing with financial derivatives and financial contracts of these tulips. And that was when greed and debt kicks in. Yes, greed is already there, but now when you couple this greed and debt, everybody wants to get rich. This is when your Uber driver says, I'm going to dump all of my money into this investment that everybody is making a lot of money on. The garbage driver is putting a lot of money into these investments because everybody's getting rich off it. Everybody's getting rich. So you hear everybody pouring their money into something that they don't understand. And a lot of times it's being fueled now with debt. So people are putting in money that they don't have because everybody's getting rich. And why are they putting the money in? Not because they understand the asset, but because people are getting rich. I want to own the thing that's going to make me money. I don't actually care about the asset. So now when you fuel that with debt, now this asset price keeps going up and up and up, and eventually we get to the point where buyers go away. Buyers realize this is a little bit too rich, a little bit too valuable, a little bit too much money for me to keep buying. As the buyers go away, now people start to panic. And that's when the downturn happens. These are the factors that you want to pay attention to that we have seen happen decade after decade, century after century, which now probably has you wondering, well, how do you actually make money? Poop? Yes, I said poop. P-O-O-P. Every time you see an economic downturn, poop happens. What is poop? Panic leads to overselling, leads to opportunity, leads to profits. That's what poop is, because every time we've seen a downturn, it creates opportunity for the financially savvy to come and buy great investments at a discounted price. During the pandemic time, when stocks and crypto are being sold off at the fastest rate we have seen since the Great Depression, that created panic because everybody was selling, which created the overselling, which created the opportunity for some people to come in and buy good investments at a discounted price, which created the opportunity to profit. Same thing to the 2008 housing market crash. People were panicking, which led to overselling. What do I mean by that? We have foreclosures. We have people selling their houses because they were scared the house price was going to be worth nothing. People were selling stocks because they were scared. And all the overselling led to opportunity for some people to come in and start investing in real estate and buy stocks at a huge discounted price, which created the opportunity for profit, because we know that stocks are a whole lot higher today than they were then. We also know that real estate is a whole lot higher today than it was then. Same thing to the dot-com crash. People were panicking. There were articles saying that the internet is no longer going to be a thing, which led to overselling. The overselling created opportunity. Amazon stock fell by more than 90%. And yes, that creates an opportunity. Of course, many internet companies went bankrupt, but the good investments were on sale. And that creates opportunity for profit for the financially savvy investors. I don't know about tulips because, well, the tulip bubble was based around, well, this fantasy that tulips were going to have all this value. But you get the idea. When there's a valuable asset, you get the asset that goes on sale, which creates opportunity for profit, which might have you wondering, well, that's what are we seeing happen today? Let me show you. Read this headline that I just saw on Yahoo Finance. The new normal. Wall Street says high stock valuations might be here to stay. This is interesting. Take a look. Over the last 100 years or so, we have seen the average PE ratio in the stock market be at around 20 times. What that means is that over the last 100 years, the average investor has paid around 20 times earnings to buy a stock. So if you run a company and it makes $1,000 of profit, historically, what has been considered normal is to value your company at 20 times profits. So you made $1,000 of profit. 20 times that is $20,000. That has been considered average in the stock market for the last 100 or so years. Today, we're seeing something a little bit different. Today, in 2025, the average PE ratio at the time of recording this video is around 27 times, which means people have higher valuations today than the average. This is where we have two types of people. We have some people like the article that I just showed you saying this is the new normal, that this is just how things are going to be now. And then you have other people saying, I don't know, this seems a little bit overvalued. I'll let you ultimately decide. But take a look at this chart. This is a chart showing PE ratios, and what you can see is that PE ratios peaked in 1933 during the Great Depression, and then they fell. Fast forward to the year 2000, and we saw PE ratios peak again before it crashed when the dot-com bubble burst. Fast forward to 2007, we saw PE ratios peak again right when the housing market began to collapse in 2007. And then fast forward to the year 2020, PE ratios peaked again right before the pandemic hit, and now, today, we're at some of the highest PE ratios really we've ever seen. But one of the things that I'm not the biggest fan of, especially in finance, is people telling you what to believe because personal finance is personal. The reality is, there's a saying in finance, bulls make money, bears make money, pigs get slaughtered. What that means is bulls, people who think the markets are going to go up, they can make a lot of money. Likewise, bears, or people that think markets are going to go down, they also can make a lot of money. The people that go broke are the people that get greedy. And so it really doesn't matter if you're more bullish or bearish. You just have to understand what's happening. That way you can make a smart decision for yourself, because there's a lot of ways to make money up or down. But we talked about now how some people say that this is going to be the new market normal, while other people, I'll give you an example. Deutsche Bank says that this is not the new normal and this is a problem that they're concerned about. What do I mean? Read this. Spikes in margin debt. The money investors borrow from brokers to buy stocks are flashing warning signs eerily reminiscent of late 1999 and mid-2007, just before the dot-com crash and the global financial crisis. Now here's the thing. We know the market crashes happen. We know that recessions happen. Most people don't want to believe it because that makes you feel uncomfortable, but the reality is they are a part of our economic system. We don't know when it's going to happen next. A lot of people make the mistake of saying, I'm only going to invest when we're in a recession, but instead what I want you to understand is this is how recessions work. This is how market crashes work. It is going to happen again, and well, three things are going to happen. Most people are going to lose money. Some people are going to be equal or stay the same. A few people are going to become incredibly wealthy. If you want to be one of the few people that become incredibly wealthy, well, you're going to understand that, well, there's things that happen and we don't know what's going to trigger the market downturn per se. We don't know when it's going to happen, although there's a lot of concerns about the United States national debt. There's concerns about AI being a bubble. I am very bullish on AI, but I also understand that it can be a bubble, kind of like how the dot-com bubble happened. All of these things could create a downturn, which also create opportunity when you understand poop and when you are financially prepared. Because now you are educated, you understand how this works, but you also have to be financially prepared, because if a downturn were to happen next year or 5 years from now or 10 years from now, you want to have the capital to be able to go out and buy good investments at a discounted price. That's where your research comes into play. That's where your smart financial habits come into play, because you don't want to start preparing when things go bad. You want to be preparing when times are good. That way you're ready for when things go bad, because we know that markets go up and down.